You ever look at a company's financial statements and see this huge line item, property, plant, and equipment, worth billions of dollars? We're talking about the massive physical stuff that makes a company tick. Their factories, their fleet of airplanes, their heavy-duty machinery. Well, in this explainer, we're going to pull back the curtain and tell the life story of those assets. We'll follow their journey from the day they're bought to the day they're finally sold. Okay, let's get into it. So it all kicks off with this really fascinating question. If a company spends $1 billion on a shiny new factory, what's its value on the books? And how does that value change over, say, 20 or 30 years? You're about to see that the number on the financial statements is almost never what you could sell it for on the open market. It's an accounting figure, and it tells a very, very specific story. All right, let's get the official definition out of the way, straight from the accounting rulebook, IAS 16. These are physical, long-term assets. The key thing here is they're not for sale. These are the workhorses of the company. They're expected to be used for more than a year to help generate revenue. Think of them as the core building blocks of a company's entire operation. Okay, so every story has a beginning, and for a tangible asset, that beginning is its initial measurement. This is the moment its value is first calculated and put on the books. This is Chapter 1, the day it's born, financially speaking. Now, you might think the cost is just the price on the invoice, but nope, not even close. Accountants have to capitalize all the costs that are necessary to get that asset up and running. That means you're including the purchase price, sure, but also delivery, getting the site ready, installation, even the estimated cost of taking the whole thing apart decades from now. It's a much bigger, more comprehensive number than just the sticker price. Let's make this real with an example. Say a company is building a new office. The price of the land? Yep, that's it. Prepping the site? Absolutely. The architect's fees? You bet, it's directly tied to the project. But what about stuff like spoiled materials for a mistake on site, or just general office overheads? Nope, those are excluded. Accountants see those as abnormal or indirect costs, so they get treated as a regular expense. They don't get added to the asset's value. And after you've made all those calls, what's in, what's out, you land on a final number. For a new office building, the total capitalized cost that goes onto the balance sheet is $519,000. That's its starting value. That's page 1 of its story. So the asset is built, it's working, it's making the company money. But its story is far from over. Now we get into Chapter 2, the middle years, where we explore how its value changes over its long, productive life. Because that number on the books does not just sit still. Right at the beginning, a company hits a fork in the road. They have to choose one of two paths for how they'll account for the asset's value over time. On one hand, you've got the cost model. This is the simple, predictable path where the asset's value just steadily goes down. On the other hand, you've got the revaluation model, which is way more dynamic. It tries to keep the asset's book value close to its current market price, which means, yep, the value can go up or down. So if a company picks that first path, the cost model, the star of the show is depreciation. Now, this is absolutely crucial to understand. Depreciation is not about the asset physically wearing out or its market value dropping. It's an accounting concept. It's just a systematic way to spread the asset's cost over all the years it's expected to be useful. You're just matching the expense to the time period it helps generate revenue in. Okay, but here's where it gets a little more complex. Think about something like an airplane. It's not just one thing, right? You've got the body, the engines, the interior, and they definitely don't last for the same amount of time. So, how in the world do accountants deal with that? Well, the answer is something called component depreciation. It's brilliant, really. You break the asset down into its significant parts. In this case, the aircraft body might be depreciated over 20 years, but a major overhaul, which gets treated as its own component, only lasts 5 years, so it's depreciated much faster. For those first 5 years, you'd be looking at a total depreciation charge of $2 million a year. All right, let's rewind and take that other path we talked about, the revaluation model. Instead of that slow and steady decline, this model says, hey, let's periodically update the asset's value to what it's actually worth in the market right now, what accountants call its fair value. This is super popular for things like land and buildings, which, as you know, often go up in value, not down. So what happens when that building's value shoots up? In this example, its value jumps by a cool $344,000. But, and this is a big but, that gain doesn't hit the income statement as profit. Instead, it gets tucked away in a special account in the equity section of the balance sheet called the revaluation surplus. Because it's an unrealized gain, it's kept separate from the company's day-to-day profits. Of course, no story would be complete without a few plot twists, right? So, Chapter 3 is all about the special circumstances and kind of complex rules that can pop up and change the narrative during an asset's life. Here's a classic plot twist. A government wants to encourage a company to invest, so they give them a grant, basically free money, to help buy a new machine. It happens all the time. But how do you account for that? Well, the accounting rules, specifically IAS 20, actually give companies two options. Method 1 is to just subtract the grant from the asset's cost. This is called netting off. Method 2 is to treat the grant as deferred income and slowly release it as income into the profit and loss statement over the asset's useful life. Let's look at the numbers for Method 1, the netting off approach. You start with your $100,000 asset, you subtract the $15,000 grant, and you're left with a depreciable amount of $85,000. That gives you a lower annual depreciation expense of $17,000. It's pretty straightforward. Now check this out. With Method 2, you depreciate the full $100,000 cost, which is a $20,000 expense. But at the same time, you recognize part of the grant as income each year, $3,000 in this case. So you have a bigger expense, but also new income, and the net effect on your profit, $17,000. You end up in the exact same place. The journey's different, but the destination is the same. And here's our second plot twist, and this one feels a bit counterintuitive. Normally, when you pay interest on a loan, it's just an expense, period. But if you take out a loan specifically to build a major asset like a huge factory, the interest you pay during the construction period can actually be added to the cost of that asset. But whoa, you can't just do this whenever you feel like it. The rules in IAS 23 are super strict. You can only capitalize that interest when all three of these things are happening at the same time. You're spending money on the asset, you're incurring borrowing costs, and you're actively working on it. The second any one of those things stops, you have to stop adding interest to the asset's cost. All good things, and even all hardworking assets, must eventually come to an end. So we arrive at the final chapter of our asset's life story, disposal. This is what happens when it's sold, scrapped, or just retired from service. When an asset takes its final bow, there are two main accounting steps. First, you figure out if you made a profit or a loss. You just compare what you sold it for with its final value on your books. The difference goes straight to your income statement. Second, remember that revaluation surplus from earlier? If there's any of that left for this specific asset, you can now transfer it directly into your company's lifetime profits, which are called retained earnings. So when you boil it all down, the big takeaway is this. That single number you see for property, plant, and equipment on a balance sheet isn't just a number. It's the last page in a very long story for each individual asset, a story that's been shaped by choices, estimates, and a very specific set of accounting rules from day one all the way to the end. And that brings us to the final big question. After this whole journey of capitalizing costs, of depreciating, of maybe revaluing, after all of these rules and procedures, does that number on the balance sheet actually tell us what a company's assets are truly worth today? Or does it just tell us the ending of a very carefully constructed accounting story? That's something to think about.